I'm going to start exactly from question 1, because your work is not a lot of work to do. So in this question, you are requested to fill up this table, right? You are requested to fill up this table, and I'm going to assist you on how to fill the table, right? I'm going to assist you on how to fill the table. So before we fill this table, I want us to understand a better way of debiting and crediting, right? So in order for you to debit or credit, you need to understand the elements of financial statements, the principles of the elements of financial statements on how they work in terms of debit and credit. I hope you guys are following. So I'm going to just draft you a table of the elements so that you can better understand where I am going with this. So I just want to check if you guys know the types or the elements of financial statements, if you guys know the elements of financial statements. Hello, are you guys there? I just want to check if you guys understand or know the elements of financial statements.
We don't.
You don't. So these are elements of financial statements that are 5. I'm sure you know them, but maybe you don't know that they are elements of financial statements. Elements of financial statements.
It's assets, owner's equity, liability, expense, and income.
Yes, elements of financial statements are the one that she just mentioned right there. Those are elements of financial statements. It's assets, elements of financial statements. I'm just gonna do this so that you guys can follow. Okay, and then these elements are divided into 5. There are 5, and then they've got 2 sides. In accounting, we've got 2 sides, which is debit and credit, right? We've got debit and credit side. We only have 2 sides, which is debit and credit. And then I'm gonna show you what is the meaning of debit and credit in terms of the elements, so that you understand we don't just debit or credit. We don't just guess, or maybe this one we must debit, maybe this one we must credit. All right. So so we'll take it from there. So number 1, we've got an asset. We've got assets. So anyone who knows where does assets increase or decrease? Asset increases on the debit side, okay?
Debit side.
Asset increases on the debit side, increases, right? Of which I'm just gonna put bracket there and say plus, okay? And then decreases on the credit side, decreases on the credit side. All right, and then that is how we identify this decrease, increase, and debit, credit. And then we've got another one. What is the other item, or what is the other element?
Liabilities.
in order, in an order way. We usually will come owner's equity, okay?
Yes.
So the other way we have to have owner's equity. Owner's equity. So now where does owner's equity increase or decrease?
Increase on the
Increases
debit.
on the debit side and increase on the credit side.
Increases on the hello.
Increase on the credit side.
Owner's increases on the
Credit side.
increases on the credit side. So on equity, we've got an increase on the
Credit side.
increase on the credit side, and then decrease on the
Debit
side.
side.
so if you can master this, I'm telling you, if you can master this, and then they bring this type of a table or where you have to deal with debit credit, I'm telling you, you won't have to struggle. Are you with me? And then we have liabilities. We have liabilities. Liabilities increases on the decrease on the
Credit
debit side,
side.
right?
Yeah.
And then increases where? On the credit side. It's same principles as owner's equity, right?
Yes.
Same principle
Yes.
as owner's equity. And then we have income. We've got income, that is number 4. We've got income as well, increase on the credit side. And then it's gonna decrease on the debit side. And then we've got assets. I mean expenses. We've got expenses. We have expenses. So expenses decreases on the credit side. Decreases on the credit side. And then on the debit side, they increase, right? On the debit side, they increase. They are same as assets in terms of the principle, right? So now, why am I doing this table? This table is going to be the one guiding us on whether we must debit something or credit something. I don't know if I make sense from there. So, what I'm going to do, I'm going to go by transaction to transaction based on the information are given here, right? So they're saying the following transaction in order for us like to fill this table, but you'll understand why I had to bring these elements so that we better understand what I'm exactly going to do. So they're saying the following transactions relating to the dream dress sewing took place during January 2024, right? So let's see. Let's start with transaction number 1. So transaction number 1, they're saying the owner contributed a sewing machine to the value of 15,000 and 20,000 cash to the business, right? So how do we record transaction number 1 in this table, right? So now, listen, you need to outline 2 or more accounts affected on each transaction. Are you with me? And then here, as I look, they say the owner has contributed a sewing machine to the value of 15,000 and 20,000 cash to the business. So how many accounts are affected on this one is 3 accounts. Are you with me? It's going to be 3 accounts. Number 1, the owner has contributed a machine. So machine is affected on this transaction. Number 2, the owner has also contributed cash, which means bank. In accounting, cash we refer to bank, right? So, or bank refers to cash in accounting. So bank is one of the accounts that are affected in transaction number 1. And number 3, every time when the owner contributes any resource in the business, it can be financial resource or assets, right? Or different kind of assets other than the cash, right? So you must just know that whenever the owner is making a contribution, that contribution, whether it can be a money or any different type of assets, that is capital. Whenever the owner is contributing a machine, whenever the owner is contributing equipment, whenever the owner is contributing a vehicle or any other resource, just to know that is going to be capital. So we have three accounts affected. Capital, because the owner has made a contribution of machine, and cash, which is bank, right? So now, how do we record now? How do we record our transaction? Says that we need to our transaction says we need to, our format says we need to start with the number. Our format says we need to start with the number. So let's see. So now they say number, obviously number is going to be number 1, right? And then now source document, right? So this is how I'm going to record this transaction with you guys. Because I don't know how others have done it, but I'm going to record it this way. So this thing is just disturbing me. What is this now? Just need to remove this. And then so number 1, and then I'm going to record this transaction as follows. I'm going to record it twice, right? I'm going to separate the transaction of machine contributed, and I'm going to separate it from cash 1. So I'm going to record cash differently and machine differently. So now let's start with recording the transaction of the machine, where the owner is contributing the machine. So where the owner is contributing the machine, the source document is going to be general voucher. Are you with me? General voucher. Do you all know general voucher? Or I need to explain it? Hello?
Explain.
Please explain.
So general voucher, it's a source document where we record transactions that does not involve cash. As much as you see here that the owner has contributed a machine, I'm dealing with the machine transaction. So I'm going to record this transaction. I'm dividing these transactions into 2. I'm dealing with the transaction to record the machine that was contributed by the owner, and then after on transaction number 1, again, I'm going to record the cash 1. Are you with me? So general voucher, it's a source document that shows an evidence where there is no cash transaction. There's no involvement of cash in the transaction, which is, for example, the owner is contributing the machine into the business, right? That is why it's called a general voucher. It's a general voucher for the machine only. So 2 accounts affected is going to be capital, remember, and machinery, right? So I'm just dealing with that first, and then we're going to deal with the 20,000 cash after. I hope you guys are following. So now we've got a book of prime entry or subsidiary journals that are 6 plus general, right? So in these 6, number 1, we've got a cash receipt journal, which is CRJ. We've got a cash payment journal, which is CPJ. We've got a debtors journal, which is DJ. We've got creditors journal, which is CJ. We've got debtors allowances journal, which is DAJ, and then we have creditors allowances journal, with this CAJ, right? So in the CAJ, we record transactions where we receive money, right? And if you check here, we received machine from the owner, not cash, right? So, and then in cash payment journal, we record transactions where we record cash payment, where we are making payments, right? So we received the machine, not the cash. We didn't make any payment of cash, right? So, so I want you to be mindful with that so that you can be able to understand where this thing is going. Right, so we are going to record this. We are going to record this. So now we've got what's this? We've got data's journal. Data's journal is a book of prime of entry where we record transactions where we have sold or we have rendered a service on credit. So just guys with me. And then we have so here on the machine again, we did not sell, we did not render a service, we just received the machine. So we've got also creditors journal where we record transactions where we are purchasing goods for cash, I mean on credit. So there's no any credit involved there, we just received the machine from the owner, right? And then we've got our debtors allowances journal where we record transactions when the customer is returning the goods to us that are not satisfying him or her. That is our debtors allowances journal. And then we've got our creditors allowances journal where we record transactions where we return the goods to the suppliers or our creditors, the goods that are not satisfying us or maybe they are damaged or whatsoever, right? And then we've got the master journal called general journal where we can record any transaction. So any transaction can fit in the general journal, which is GJ. So our book of prime of entry here, because all the first 6 did not qualify, only the general journal, which is the master journal where we record everything, qualifies. So it means this transaction is going to be recorded in the general journal because it doesn't qualify to debtors journal, it doesn't qualify to creditors journal, it doesn't qualify to creditors allowances journal, it doesn't qualify to debtors allowances journal, it doesn't qualify to CRJ or case receipt journal, it also does not qualify to CPJ, which is a cash payment journal, right? So it qualifies to go to the master journal called general journal, right? And then in terms of debit credit, that's where the elements comes in. That's where the elements comes in. That's where the elements comes in and credit, right? So remember I said to you, we're going to start with the transaction of the machine where the owner is contributing the machine in the business. So 2 accounts affected here is going to be machinery and capital. Now it's a matter of, now we know that there's 2 accounts affected, which is going to be capital and machinery. Are you guys following? And then now it's a matter of what do we do with this? We have to debit one and credit another. Are you guys following? So in order for us to debit credit, we're going to follow the elements. We're going to ask ourselves, in terms of the elements, what is machinery? So in terms of the elements, machinery is an asset, right? And it says the owner is contributing machine into the business. Therefore, there's an increase in machines. If we had 1 machine, the owner has brought another one. That means now we're gonna have 2. Therefore, there's an increase in machines. I hope you guys are following. There'll be an increase in machine. It means there's an increase in our asset, right? So when there's an increase in our asset, it means we must debit. Why? According to the principle of the other says, whenever asset increases, we must debit, right? That is why we are going to debit our machinery. We don't just debit credit, we follow the principle. Are you guys following right there? And then we're going to credit what? Capital. We're going to credit capital. Why? Capital is an owner's equity account. Whenever the owner is contributing resources into the business, it means the value of ownership for that particular owner, it's increasing in the business, right? So that is why we're going to credit what? Capital. Because capital is an owner's equity, and whenever there's an increase in owner's equity, we credit. You see, we don't just debit, credit, we follow what? The principle. So we're gonna go there and say capital, right? We're gonna go there and say capital. Are you guys following? Do you guys get this one? Can we move to the transaction of the cash now, where the owner is contributing cash into the business? Are you guys fine with transaction number 1? No question. Hello? No question. Can we move on?
Yes, Mr. Move.
Okay, so now the next question, we're still in transaction number 1, is that the owner has contributed our cash into the business, right? 2 accounts affected is going to be bank and capital. Bank and capital. So you can record this transaction in this way. The source document, because the owner is contributing money into the business, is going to be bank statement. Bank statement. Bank statement is going to be the source document right there. And then because we are receiving money, and the book of prime of entry or subsidiary journal that we are going to record transactions where we receive money is going to be a CRJ, the cash receipt journal, because we are receiving money from the owner. So the book of prime of entry is going to be cash receipt journal, CRJ. Are you guys following right there? And then now, when we come this side, we have received the money. So in this account, where in this transaction where the owner is contributing money, we are going to have bank and capital, right? We're going to have bank and capital. So bank is going to be debited. Why? Because the bank is an asset, and there's an increase in money into the business, right? So bank is increasing, and bank is an asset, and whenever asset increases, according to the elements, we must debit. So we're gonna debit our bank right there. Remember, we don't just debit credit. We debit credit based on the elements, guidance or principle. So we're gonna have capital right there. Because remember, whenever the owner is contributing any resource into the business, whether money or whether any kind of asset, is going to be capital, right? So I hope you got that. Can we go to transaction number 2? Are you guys sorted right there?
Yes.
Yes, Mr.
Okay. And then let's go to transaction number 2. Transaction number 2, they say to you, you have rendered a sewing service for a wedding to a client on a credit, right? On credit for 45,750. Right? Anyway, remember here we're not required to record any amount. We're just gonna record the number, the source document, the prime of book, the book of prime of entry, and the account to be debited and account to be credited, right? So now, what is the source document whenever we render a service on credit? When we render a service on credit, when we sell a service on credit, what is going to be your source document? Your source document is going to be a duplicate invoice. Are you with me? Duplicate invoice. Duplicate invoice. Duplicate invoice, right? So I'm going to give you an example just for you to understand why duplicate invoice, right? So duplicate invoice, it's a copy of the machine. It's a copy of a receipt, of an original receipt. Are you with me? Because remember, source document are just receipts, again, given when you when the transaction is taking place. That shows an evidence that a transaction is taking place, right? So duplicate, let me show you something. Here it's you as a business, right? And then there's a client. There's a client that you sold a service to. So I want you to check when you go to ShopRite. If I'm not sure if you are aware of this, right? When you go to ShopRite and buy goods there, do they give you the first receipt that comes out or the second one? Let me just hear this one. Anyone who want to try this one? Or anyone who remembers?
They give us the
The
original.
second one.
They give you
They
the
give you
second
the
one.
second one.
Are you sure?
The first one. The
They give you the
original.
first one. Are you
one.
with me? So remember, you guys don't check. They give you the first one, not the second one. Are you with me as a client? They give you the first one, not the second. The second one they keep. Are you with me?
Yes.
So now, why duplicate? Because you are going to give the original to the client, original invoice to the client, and you keep what they duplicate. That's why at ShopRite, they give you the first one, which is the first one, it means is the original receipt. And then they keep the duplicate. So you here, and at this time, you are the ShopRite offering a service to a client, you keep the duplicate. Right? So, and every time, remember, when there's a credit transaction, just know that a source document called an invoice will be incurred. You just have to know whether is it a duplicate or original. So how do we differentiate a duplicate and original? We differentiate in this way. We check, are we the one buying or are we the one rendering a service? If we are the one rendering a service, we are going to give the original to the client and keep the duplicate. And we are going to record in our books, duplicate that particular receipt. Here we are going to duplicate an invoice. Why? We are going to keep a duplicate invoice because we are giving the original invoice to the client and we keep what we are keeping. Because it means the first receipt came out, which is original, we give to the client. Then the second one, which is a duplicate, we keep. I don't know if you follow. So that is how we differentiate. How do we determine whether it's original or is a duplicate? A duplicate just means a copy. So original is original, but a duplicate just means a copy of that other original. So I hope you guys follow. I'm trying to just make it simpler that way. I don't know if you guys follow. And then since we have rendered a service on credit, the book of prime of entry is going to be the book of prime of entry or subsidiary journal is going to be debtors journal, DJ. That's where this is the book where we record transactions when we issue, when we sell a service or when we sell goods on credit, right? Or when we render a service on credit. This is the book where we record credit sales or credit where we render a service on credit, right? So, and then two accounts affected on this is going to be debtors and service rendered. So a debtor is an asset. If we had no debtors, no one owing us, is zero. But now we've got a plus one debtor that has come, and we rendered a service two on credit. Therefore, we're going to debit a debtor here because a debtor is an asset, and whenever they increase, we must debit them. So we're going to credit our debtors, or maybe debtors control, or maybe account receivable, right? And then we're going to credit a service rendered. Service rendered is an income account. It's an account where we make income for, right? When we render a service, we are expecting an income. So service rendered is an income account. So whenever income increases, the element says we must credit them, you see. So we are going to credit our services rendered or service rendered. Are you guys following? Are you guys still there? Can I move to transaction number 3? Do you guys understand transaction number 2? Hello? Do I still have people here?
Yes.
Okay. And then transaction number 3, they say you have rendered a swing service amounting to 32,460 cash, right? So in this case, we need to record what? We are selling, you know? Is us are rendering a service. So what is the source document? It's going to be duplicate receipt. This is exactly what they give you at ShopRite when you buy, because you buy for cash. So you're gonna have what we call a duplicate receipt, because it's a cash transaction, right? And then the book of prime of entry is going to be cash receipt journal, because the person has bought or we have rendered a service for cash, and then it means we have received the money immediately for that service. This is a cash transaction where we're receiving our money, right? So when we receive money, bank will be debited because we are receiving more money, and then bank is an asset. An asset, when it increases, we must debit, right? And then we are going to credit service rendered, because service rendered, remember, is the same as transaction number 2 there. Service rendered is an income account where we are making an income through rendering a service. Therefore, there's an increase in incomes, and we must credit incomes as they incur in the business, because the principle says whenever income increases, we must credit them, right? I'm just going to keep on reminding you this, because remember, we don't just debit credit without, we just assuming. No, we must understand the principles of the elements of financial statements. So can I go to transaction number 4?
Someone raised their hand.
Yes, those who raise their hands, please just stop me, né? Because sometimes I can't see. Just stop me and just unmute and talk. Don't worry. Yes, those who are raising up their hands, please talk to me. Hello? Are they still raising, or they are fine?
If you don't want to talk, you can move on.
They are fine. All right. When they are ready to talk, they will just unmute and stop me and ask a question. I'll try to go back and explain again. No problem. Let's go to transaction number 4. So transaction number 4, they say bought address materials for 3,872 on credit from ABC supplier. So here you are buying on credit. What are you buying? Materials, right? So materials, you are buying materials on credit. So when you buy on credit, remember, now you are the client to the supplier. So the source document is going to be original invoice, because you bought on credit. Remember, in transaction number 2, we had duplicate invoice while you were selling, or you were rendering a service. Now they are rendering a service to you by your supplier. So the source document will be original invoice, right? It will be an original invoice. And then where are you recording these transactions? Where you buy goods, or maybe you buy whatsoever you are buying on credit. You are going to record this transaction in the in the creditors journal, which is CJ. We're going to record in the book of prime of entry called CJ, which is creditors journal, right? And then 2 accounts affected here is going to be materials and creditors. So materials are assets. Are expenses. Materials are expenses. Sorry for that. Materials are expenses, and then we are going to debit materials, because whenever there's an increase in an expense, we debit, right? So we're going to debit materials here. We're going to debit materials and credit what? Creditors. Why creditors are credited? Because creditors are liabilities, right? Creditors are liabilities. And whenever there's an increase in liability, we credit. Whenever there's an increase in liability, we credit. It's like, for example, if you are owing someone 5,000, you go and borrow again to someone. Now, maybe you borrow another goods for 2,000. Now you are owing 7,000. So there was an increase in your liabilities that you are owing people more than what you were owing them. That is, I'm just trying to give an example for better understanding. So if there's an increase in your creditors, you are going to credit them because creditors are liabilities and liabilities increase on the credit side, right? And then we are done right then. We can go to transaction number 5. If there's any question, please don't forget, just unmute and say, sorry, may I speak? And then I'll listen to you, or may I ask a question? I'll also listen to you, and then I'll also help you in terms of that. And then let's go to transaction number 5. So transaction number 5, they say to you, received a credit note for poor quality of material, 500. So when they say you've received a credit note for poor quality of material, a credit note is a source document where you are returning goods or goods are being returned. That is a credit note. How do they differ? They differ when, if you are receiving a credit note, it means you are the one returning the goods to the supplier. But if you have issued a credit note, is when you are receiving a return of goods that you have sold to the clients. When you receive goods, or when the client is returning the goods that they bought from you, is going to be you issuing a credit note, the customer receiving. But now you are the customer to your suppliers, you are receiving a credit note. Therefore, it means you have returned poor quality materials to your supplier. Are you with me? So the source document here is just given. It's a credit note received. Credit note received. Please don't fear to ask questions, okay? Because I am not here to just speak alone. You can ask questions and then we take it from there. Don't fear to ask questions. Don't worry about what other people will say. Yes.
You said that when you receive, like now on 5, a credit note, it's the source document is credit note received. Thank you. So
Yes.
if you issue a credit note, what is it, and also what's the book of prime entry for it?
So when you receive a credit note, the source document is a credit note received. Are you with me? And then when you issue a credit note, the source document is going to be called credit note issued, right? And then when it comes to the book of prime of entry, credit note received, our book of prime of entry is going to be CAJ, which is creditors allowances journal. And then when you issue a credit note where the source document becomes credit note issued, the book of prime of entry is going to be debtors allowances journal. It's going to be DAJ. Did you get that one? I'm just trying to differentiate the two so that you better understand in that case.
Yes, Mr.
All right. Are you fine? Did I answer your question?
Yes.
All right. And then now, remember, now since you are returning the goods to your supplier, remember your suppliers, you were owing them 3,872. So if you are returning the goods for 500, are you still going to pay them this amount? It means you have to decrease 500 that you return the goods for. Do you understand? So it means now there's a decrease in your creditors due to return of material. So when it means there's a decrease, and when materials are, creditors are decreasing, which is your liabilities, we must debit them. It means we have to debit our creditors right then. Creditors, because they are decreasing due to purchases returns of materials. Right? So creditors, and then you can come there and say materials. Because you have returned, because if you bought 5 materials from your creditor and then you return them, it means there will be a decrease in materials from your business, right? That is why we're also crediting your material. And but materials also, remember I said there are expenses. That means the expenditure of material will decrease. And whenever expenditure decreases, we credit, right? So that is why I'm crediting our material. Again, it's just the vice versa of transaction number 4. I don't know if you follow or if there's any question. Can I move to transaction number 6? Are we good?
Yes.
If there's any question you ask, I'll clarify everything. And then transaction number 6. Transaction number 6. Transaction number 6. Let's see what are they saying right there. Transaction number 6, they say you paid 2,000 rand to suppliers. Here you are paying your suppliers 2,000 rand, right? So when you pay your suppliers, as you pay them, they're gonna give you an original receipt. Are you with me? They're gonna give you an original receipt, or they didn't indicate whether you paid it through your bank or you EFT or whatsoever. So you can say EFT, right? You can say EFT as well. It's gonna still qualify. Or you can say original receipt. You can say original receipt because it's where you are making a payment to your suppliers. They will give you original receipt, or you can just put EFT, original receipt, or you can just put EFT because you made a payment to your suppliers. EFT can still qualify. Bank statement can still qualify because if you paid by transferring the money, that is EFT, and then it will also reflect on your bank statement. So bank statement can still qualify as your source document here. Are you following? And then since you made a payment, the book of prime of entry or subsidiary journal is going to be cash payment journal, CPJ, right? CPJ. And then you are paying your creditors. So when you pay, if you were owing your creditors 5,000, you paid them 2,000. It means there's a decrease in what? In your creditors, right? And whenever creditors are decreasing, these are liabilities. They're gonna decrease on the debit side. So you're gonna debit your creditors, right? You're gonna debit your creditors, and then you're gonna credit your bank. Your bank is decreasing here. Money is decreasing, right? Money is going down. So whenever there's a decrease in money, there's a decrease in the bank, and then the bank is an asset. Whenever it decreases, you credit. So bank on the credit side, right? And then I hope you guys understand. Let me just finish the last transaction on this question, and then I give you 2 minutes if you've got any questions to ask, and then we'll take it from there and move forward to the next question. So now, transaction number 7. I say to you, let's see, wages paid for the month amount to 3,500. You have paid wages. Wages is an expense, right? You are paying your employees. Are you with me? So when you pay your employees, remember, there is a payroll. A payroll can be a source document of the business. Payroll, pay slip, even a bank statement, because maybe you are not paying them envelope, but you're not paying within an envelope. You are maybe transferring the money into the account, leaving your bank account as a business. So even a bank statement can still, like bank statement can qualify in a lot of things here. So payroll can be because the business prepares payroll to pay their employees, right? So payroll can be a source document, because remember, a source document, it's a document that shows an evidence that a transaction has taken place. So a payroll can also indicate that you've paid people or someone a wage, and then that payment, the book of prime of entry, CPJ, right? Because you're making a payment. And then two accounts affected, remember, is wages and bank. So wage is an expense. Whenever there's an increase in your expenses, you debit, so wages. And then there will be a decrease in your bank account. There will be a decrease of money, of cash in your bank. So bank is an asset. Whenever it decreases, we credit. You guys follow? Now, if you guys follow, let me hear questions. If there's any questions, maybe for 2 minutes before I jump into another question. Hello? Can I move to the next question? Are you guys happy with this one? Do you have any questions? Yes, ma'am.
Can I ask, so when it comes to like EFT payments, it does not get to a point where we have to say original or duplicate.
No. EFT,
just
say
write.
EFT.
Okay,
EFT,
thank
we
you.
just say EFT, and EFT is affected where you just have to, where you are making payments. Are you with me? When you receive money, don't even bother and say EFT, please. Are you with me?
Yes.
Yes. So is there any question? Let's just ask on this, because I want to make sure that whatsoever question you get clarity for, and then we take it from there. Are we happy? All right. I think everyone is happy on this question. I'm going to move to the next question, right? Remember, don't forget, wherever you are going to debit and credit, please apply the elements. Apply the elements. So I'm going to do question. I'm going to do question. Let's see. Should we do this one, or maybe we should do question 3? Which one is better for you to do? Let's see. Let me just hear from you.
Second question.
Hello.
Question 2.
Question 2. Okay, no problem. We'll do question 2 just now. So question 2, they want you to prepare. They want you to prepare. They want you to prepare ledger accounts, T forms, right? So I'm going to give you a structure of a T form so that we all better understand how T forms work. So question 2. So because of time, I'm gonna do only question 2. Are you with me? I'm gonna do question 2. So I'm just gonna give you a structure of this first, so that we better understand what we are doing, right? Are you guys fine with that?
No.
So I want us to just go and do this. So question 2, I want a structure where we can do a better question 2, so that we understand this ledger accounts. Let me just check where I've done this structure so that we can just have a way forward quickly. Okay, let me just draft it quickly. So now, remember, with this question, we have to prepare ledger accounts, which is the T forms, right? The T forms. So T forms are also divided into 2. Are also divided into 2, right? Which is debit and credit as well. So I'm not gonna draft a lot of things. But remember, date is important as well in this. Date is very, very important as well in this. Date is important. So, and then we are going to identify accounts affected as well. So, please bear with me. Bear with me. Please bear with me for now. Just hold on a second. Just hold on a second. I'm just trying to get a better way of explaining this. I don't want people to come and say, hey, this one very misled us. So I'm just going to add other structures right there. When I show you how the ledger accounts should be, I'm going to go and give you a complete ledger. So a complete ledger looks like this, ne? A complete ledger. Complete ledger must have a date here. Complete ledger must have details. Must have details. A complete ledger must also have folio, but I'm not going to dwell into folio because you guys, you mostly don't utilize or record anything in the folio. And then this is your what? This must be let me show you. Good. I want to just do things from the beginning so that you guys tomorrow you just go and kill this thing. Okay, so let's say this account is it's maybe capital, or let's say it's a bank account. Let's say it's a bank account. Let's say this is a bank account, right? I'm gonna indicate bank up there, and then let's say this is a bank account, and then on this is the debit side of the bank account, for example. Debit side, DR there. And then I'm just gonna put this one on the middle, right? As you draft there in your test. And then on the credit side, you're still gonna have this. So now on the credit side, I'm just trying to demonstrate it better, okay? Because I'm not using proper format, but I'm just trying to, try to do the right thing. Okay, and then on the credit side as well, you're gonna have date. You're gonna have details. You're also gonna have amounts. I'm not gonna show the folio because the folio, remember I said you don't literally you don't utilize it. So it's gonna be date, details, amount, right? So now this must be the account. So now let's go to check in transactions there. In the transaction, can we go to transaction number 1? I'm just gonna let me just add this so that we don't have to come back, add. We're just gonna copy and paste. Let me do this. Okay, so this is how the T form must look like. It must have its own debit and credit, right? The only thing that I did not involve there is a folio, right? So I'm not going to include folio, okay? I don't think you need it, but I won't include it for now. So this is how the T form format must look like. Okay, and then now let's see. Let's go to transaction number 1. Let's say this is a bank account, and then let's see what are they saying in transaction number 1 right there. So transaction number 1, they say the owner. Are you all there? Hello, are you still there?
Yes.
Yep.
Yes.
Okay. So transaction number 1, they say to you, okay, let me just see. They say the following balances and totals appear in the books of Heyday Plumbers, and then they give you bank, vehicle, equipment, capital, service rendered, account receivable or debtors, accounts payable, and creditors. Fine. And then transaction number 1, they say the owner increased his capital to 100,000. The owner increased capital to 100,000. So if you check, the capital was 75,000. When they say he increased to 100,000, it means he topped up by how much? By the difference between 100,000 and 75, which is how much?
25.
25. So
25K.
yes, so 2 accounts affected on this transaction is going to be capital and bank. Do you agree? It's going to be capital and bank. So it means we must have another T form. I'm gonna copy this one. Try to copy this one. Just record it and put it below. Let's see if it will work. Okay, so I'm just gonna remove bank there and put capital, because we've got two accounts affected on transaction number 1, right? So now we have to record these transactions. Hello, is there anyone
Can I
talking to me?
ask? Yes, Mr. I'm confused. Is this the format that we're supposed to use tomorrow, or we should use the one you've always been teaching us?
You can use this one, you can use the one I've been teaching you, because most of the time I'm just trying to make sure that things are clear. You can use this one because if you understand this one is still going to be fine, because just a matter of debit credit is not a big deal. Because with you guys, I think they need to test your knowledge of understanding the ledger. But please don't forget, maybe we can put the dates. Are you with me? So don't worry about it, because there's nothing different. We're still going to debit credit, indicate the details and the amount. So you can use this one, you can use the one I taught you in class. The one that you think works better for you is still fine. Are you with me?
Okay, thanks. Yes.
Yeah, I'm just trying to show you how the real ledger looks like. So now, bank, right? So we've got the bank and capital affected, right? So when I record, I'm going to check. They say we're preparing the books of transaction number 1, again, which is transaction number 1, January. And then remember, the books that we're doing is 2024, right? And then now, remember, if you check on the information provided, on the information given on the question right here, there is these are opening balances, all of them, these ones, all of them, they are opening balances. So now we have to record the opening balance of the bank. The opening balance of the bank is 35,000. When we go into the bank account, when you go into the bank account in the sheet there, is going to be okay. It's going to be balance carried down, balance brought down, right? It's going to be balance brought down. Balance brought down, right? Balance brought down and it means opening balance 35,000. Number one, that's how you start. Are you with me? So you're going to say balance brought down 35,000. And then remember, there was an increase in capital. There was an increase in capital, right? Of how much? There was an increase in capital of 25,000. So you come here, the bank is increasing because the owner is putting money into the business, right? So you go to the debit side and say capital. Why the bank is increasing? Because the owner contributed money, capital. Are you with me? And then you go to the amount, you say 25,000. This 25,000, we got it by, I can just do, it's not necessary to do this calculation, but if you feel like you can do it, you can do 100,000 less 75,000. That's how we got the 25,000, because the owner has increased from 75,000 to 100,000. By how much? By 25,000. I know some of you are going to record 100,000 and then no. The owner has increased. He didn't contribute 100,000. The other 75,000 was recorded long ago when he contributed at that time. Are you with me? So if you're going to record 100,000, it means you are recording the 75,000 twice. So it's going to be a lot. And then you go to your capital. When you go to a capital, you apply what we call a double entry system or duality principle. Are you with me? Duality principle. So remember, capital is an owner's equity account and increase on the credit side. So date there is going to be 1 Jan 1 January. Just write it like this. On the date, right there, 1 Jan 2024. And then opening balance is there. Balance brought down. Your balance brought down of this equipment, remember, of this capital was 75,000 or is 75,000. 75,000. So 75,000 right there is the opening balance of the capital. And then there's an increase in ownership in capital. There's an increase in capital. Why? Because the owner is putting money, bank. This is where we apply our interest system or duality principle of how much? 25,000. I don't know if it makes sense up to so far. If you check, capital under bank is debited and bank under capital is credited, where each account must have credit and must have debit, or each account must have debit and must also have credit. I don't want to find people written bank everywhere. You find, or maybe you find that under here, instead of writing capital, you write bank. No, you cannot write bank under bank. You must write the contra account. The contra account of bank in this transaction is capital. The contra account of bank in this transaction is capital, and the contra account of capital in this is bank. Do you guys understand? Do you guys follow? Any question up to so far? Because I know this one's they can give issues, these transactions like this. or this ledger accounts thing can just give issues? Hello?
No questions.
No questions. Okay. And then now let's go to the next transaction. So the next transaction, it says received a loan from Capitec Bank, 8,000. So when you receive a loan, two accounts affected, you receive demand, right? So two accounts affected is going to be loan and bank. You are receiving money for loan. Two accounts affected, bank and Capitec. I mean, a loan, bank and loan. So when you record these transactions, go to the answer sheet right there. Remember, it means now bank, we must have one bank. We're not going to create bank and one, because last year when I was checking, hey, people were writing a lot of banks accounts. So we're just gonna create one account of bank. Are you with me? So I'm gonna copy this one. Try to create another account, which is loan. Are you with me? So I'm gonna put another account there for loan. So I'm gonna remove where is that? I'm gonna try to remove this capital there and just put a loan, right? And then I will remove all of this sharp. And then this is a loan account. Remember, now that you have received the money in a form of loan, two accounts affected is bank and a loan. So bank is increasing because it's an asset and increase on the debit side. Why is it increasing? There was a loan in. There was money from loan that it came in of how much? 8,000. Right? And then you go to the loan. So let's check, does loan have opening balance? Loan does not have opening balance, right? So fine, we can proceed. Okay, so loan does not have opening balance. So its transaction number, you can come here and say bank. Contra account for loan here is bank. How much? 88,000. Remember, loan is a liability and liabilities increases on the credit side. So you are owing these people 88,000. That money came into your bank, right? And then what is the date right there? The date where you acquired the loan is 5, the 5th of January. So you're gonna say you're gonna just gonna say 5 right there. So you're gonna go this side and say the 5th of January, and then on the bank account, you're just gonna say 5th Jan. Then you are done, because already we know the year is 2024, right? And then remember, double entry system. This one, that one. Double entry system or duality principle, where every account has got a debit and has got a credit on the other account. I don't know if you follow. That is how you've got transaction number 2 that happened on the 5th of January. Are you guys following? Hello? Are you guys following?
Yes.
Okay. And then we go to the next transaction. The next transaction happened on the 9th, where you paid 4,800 for advertising. So it means we must create another account for advertising. Remember, advertising is an expense. So we are paying. So when we pay, two accounts affected is going to be bank and advertising. So bank we already have. bank account, we already have this side. We're only going to have an account for advertising. So I'm just going to create an account for advertising. Advertising. Account for advertising. And then this. Okay. And then now, two accounts affected, advertising and bank. So bank is decreasing because you are making a payment. Are you with me? Bank is decreasing because you are making a payment. When you make a payment according to the transaction on the 9th, right, of January. So you go there, you say 9 Jan. You made a payment. Details, what did you pay for? Advertising. Right? And then how much did you pay? 4,800. And then you go to the account of advertising. You've made a payment on the 9th January. And then details, bank, contra account of this is bank. You're gonna not credit but debit, because advertising is an expense, remember. So expenses, when they incur, we debit. So we are going to debit this. So we're gonna go to the debit side there and say 9 Jan 2024. And then details, bank. If you check, we have credited advertising under bank because bank is decreasing, and we are going to debit bank under advertising because advertising is an expense, and expenses, when they increase, we debit 4,800. I don't know if you guys follow. Are you guys fine? Any questions so far?
No.
Okay. And then let's go to the next transaction. The next transaction, is transaction that happened on the 12th. They say received 5,700 for service rendered. So when you receive money, bank, right? So it means you've got bank, and we have to create another account called services rendered. So let's go to our answer sheet right there and create another account, or T4, or another ledger account called services rendered. Called services rendered. So services rendered, remember, is an income account. It increases on the credit side, right? So, but you received the money for service rendered, right? Which is bank is going to increase because you are receiving money. Debit side and say services rendered. I'm no longer going to put dates, unless you saw you put dates. So it's just easy like that. Of which I believe for now it's not that much of important. And then, in case you forget, and then you've received money for service rendered of 5,700, right? Is it 5,700? And then you go to the service rendered account down there. On the credit side, there's an increase in income, which is services rendered. Why is it increasing? Because we received the money, bank. double entry system, 5,700. And then these transactions, I didn't put the date up there, but it happened on the 12th. Are you guys following? Just like that.
Yes.
You see? So here you can just say 12. And then that is how you record that transaction. And then let's go to the next transaction. So the next transaction happened on the 18th. You made an EFT to pay telephone account. So we are going to create another account, telephone. And you also rendered a service on account. So we're going to separate two accounts. There's telephone and then there's service rendered, right? So let's start with telephone. On the 18th, two transactions happened right there. So I'm going to create another transaction. I mean an account.
Sir,
Yes.
is service rendered in opening balance?
What?
Is service rendered in opening balance?
Oh, service rendered has got an opening balance.
Yes.
So it means here we have to say 1 million, and then this one must come below there. Yes, this one must come, and then here we must have balance, because remember, service rendered, right? It's service rendered. It's an income account where it increases on the credit side. So opening balance of this account will be on the credit side. How much is that? Let's see. And then and sorry for that because I missed it. I missed that one, and thank you for reminding us. Service rendered 5,400, right? So it means balance brought down for that is going to be 5,400. 5,400. So this is how we're supposed to start. And then here, date is 12. I want to put the month because all transactions, I just put the month somewhere somehow, but all transactions are happened in the month of January, and we indicated on this column, so we are fine. Are you with me? So you can just say 12 right there, and then we proceed. Right, and then I was on transaction that happened to the 18th, né? And then I said we've got a new account called telephone. We've got a new account called telephone, right? So telephone is an expense, and we made a payment to this account. So when we pay, two accounts affected, bank and telephone. Bank and telephone. So telephone decreases your bank. Bank is decreasing because you made a payment for telephone. So you go on the credit side of the bank and say, and decrease your bank with telephone. And then let's check on the question right there. How much did you pay? You paid 1,450. 1,450. So it's gonna be 1,450. 1,450. And then you go to the telephone account down there. Telephone it's an expense account, right? So you debit, or you can just apply the double interest system. So you're gonna say bank there because you made a payment for this telephone, and then amount 1,450, right? 1,450, and then date it happened on the 18th of Jan. We are fine right there. And then you can put the year 2024, no problem. Even if you put it like this, no problem. Okay, and then you see debited on the telephone account under we put bank on the details. When you go up there on the bank credit side, we say telephone 1,450. Every account has got a debit and has got a credit. And then we can move to the next transaction. Same date on transaction number 18. On the day 18, we rendered a service on account. When you render a service on account, it means they just mean that you rendered a service on credit. They just meant you rendered a service on credit. When you say on account, like you've got an account in Truewords, it means you are borrowing stuff there in Truewords, and then you're going to pay at a later stage. So two accounts affected here is going to be services rendered and debtors control, right? So services rendered, we already have an account. We're just going to create another account for, for debtors. So let me just copy this one. Okay. So we're going to have another account called debtors control right there. Debtors control, or just the debtors, no problem. Okay. And then now, since we've got debtors control and we've got services rendered, two accounts affected on that transaction, remember I said is debtors control and services rendered. So a debtor is increasing here, and a debtor is an asset. Whenever asset increases, we debit. But when we debit, we're going to debit our debtors control with services rendered. I don't know if you guys are still following. Services rendered right there, and then amounts. Amounts. Do we have on the debtors control? Sorry, on the debtors control, I think we've got balance. We've got opening balance, isn't it? Balance brought down. And then let's see how much is the opening balance for debtors control. I think is there here 4,000. We're supposed to include it like that to say opening balance. Balance brought down 4,000. Right, and then of which this one is 1 Jan. And then we will have service rendered. Now I'm recording the transaction that happened on the 18th. So you can just come here and say 18. Service rendered. And then how much do you render a service for? Render a service for 8,600 on account, right? So you go there and say 8,600. Okay. And then you go up there on the services rendered. You say debtors control. Debtors control. And then how much right there? 8,600. Date 18. Right? So there's an increase in service rendered due to debtors control of 8,600. And there's an increase in your debtors due to service rendered of 8,600. I don't know if you guys follow. And then if you guys follow, let's go to the next transaction right there. The next transaction is transaction number 19. Transaction number 19, they say you've received an invoice for consumable goods bought from JT suppliers, 7,200, and received a trade discount of 5%. Okay, so now that one, in this case, that means you've got two accounts affected. On that transaction, two accounts affected is going to be consumables or consumable goods and creditors, because whenever, remember, when you receive an invoice, it means you bought goods on credit. Are you with me? You remember, receiving an invoice means you bought goods on credit, because remember, an invoice received, it's an original invoice where you bought goods on credit. It's a source document that indicate that you've bought goods on credit when you receive an invoice. So two accounts affected is going to be creditors and consumables. Trade discount, we're just going to minus 5% from 7,200. We're just going to minus 5% and record. We cannot account for trade discount. We only account it by minusing, unless if it's a settlement discount. That's where you're gonna have discount received. But here we don't have discount received. We just have a trade discount where we just have to minus that 5% from 7,200 and record the amount with less than 5%, right? So we only have two accounts: consumable goods or consumables, and creditors. So I'm going to create two accounts right now. Two accounts. Number one is going to be creditors. Creditors control. Creditors control. And the other account is going to be, the other account is going to be consumable goods. Or consumables. Consumable goods or consumables, right? And then remember, consumables are expenses, né? So they increase on the debit side. Creditors are liabilities, they increase on the credit side. So now let's record this transaction. We are going to have a creditors control. Remember, creditors control has got a balance. So it's gonna be 1 gen 20, right? And then balance, because remember, creditors are liabilities and they increase where? On the credit side, right? Balance brought down just like that. And then amount, check the amount is going to be 72,200 multiplied by 95, because remember 72,000 is amount for opening. Sorry for that. Amount for opening. Let's check amount for opening first before we do the calculation. So the amount for creditors opening is 3,500. So let's just go there. 3,500. And then we come here and say consumables. Sorry for that. We have to say consumables. And then these consumables, we're going to indicate calculations, right? So we bought these consumables with 100% amount of 77,200 we have to minus 7,000 5% of this. So this is 100% amount, but we have to record what 95% of this amount because 5% was given as a trade discount, right? So this transaction happened on the 19th, right? And then they have to calculate that. So you're just gonna say, quickly help me. Those who are having calculators, you're just gonna say 7,200 multiplied by 95 divided by 100. We already minus the 5% like that. Anyone who can help me quickly?
6,840.
6,840. Is everyone getting that? Others, just to double check.
Yes.
Yes.
Okay, that is an amount less than 5%. And then we go to the consumables account, right? Consumables, we say 19 Jan, right? 19 Jan. The 19 January there.
I think the answer on 5% is supposed to be 360.
Repeat that.
I think the answer on the 5% is supposed to be 360.
Yes, we have.
To find the
So,
percent, the 5% 5 divided by 100 multiplied by 7,200, and then it will give the percent amount, which is 360.
So 360 is the 5%. Do you agree? No, let's talk. No problem. 360 is a 5%. Do you agree?
Yes.
Yes.
But now,
Yes.
Yes.
we have to subtract it from 7,200. When you subtract it from 7,200, how much are you getting?
6,814.
That's what we must record. The 5% is out. We're not recording it because we are not going to pay that. The 5% we're not going, the 360 we're not going to pay for it. We are recording what we are owing after a discount. Are you with me? We are recording the discounted amount. I don't know if you follow. Hello?
Yes,
Say, are you following? Are you following?
Yes, you're following.
Everyone is fine now. Did you get clarity? The one that was saying 360 is 5%.
Yes.
All right. So we are good now, right? We can proceed. So this is how you record this transaction that happened on the 19th of January. And then let's go to the next transaction. The next transaction happened on the 23rd. They say the owner paid his personal cell phone bill from the business bank account. Two accounts affected is going to be bank and drawings because the owner is making a withdrawal right there. Are you guys following? The owner is making a withdrawal right there and to pay his personal cell phone. So two accounts affected is going to be drawings and bank. So it means we have to create another account called drawings. We have to create another account called drawings. We have to create another account called drawings. Right? Because the bank we already have. Because sometimes I find that people have created a lot of bank accounts. No, you create one account, you debit credit. It's no need for you to create a lot. Drawings. Okay. And then drawings, it's an owner's equity account, but it decreases the owner's equity, and owner's equity decrease on the debit side. So when you record this transaction, number one, this account is decreasing your bank because the owner took money from the bank to pay his personal stuff. So your bank is going to decrease. So you go up there on the bank account on the debit, credit side, right? Then say drawings of 2,400, right? And then you go back to the drawings account down there and say on the drawings account, it happened on the 23 January. And then, okay, and then you're gonna say bank because the owner took money there. Double interest system, 2,400. So all accounts, all these accounts have got a debit and a credit, and then we have utilized the duality principle or the double interest system, and then we are fine. Are you guys following right there? Can we go to the next transaction if there is no any other question? All right, let's proceed. I believe we are all following. Transaction number 26. Transaction 26. They say receive the rent income from our tenant. You received the money from your tenant, 14,500. So when you receive money, two accounts affected is bank and rent income. So bank is already there on our answer sheet, right? We are just going to prepare a rent income account. Rent income account or rent income ledger account, which is going to be rent income right there. Rent income account. And then now rent income, we're receiving money from our tenant, which is our client, right? So when we receive money, our bank is going to increase. Do you agree? So when our bank is increasing, we go to the bank account right there on the credit side and say rent income. Rent income. And then this transaction happened when on the 26th, you can say 26 right there, 14,500. And then after that, you go down there to your rent account. Remember, rent is an income. Rent account, this rent income is an income account that increase on the credit side. You're gonna say bank, duality principle. And then the date is 26 Jan, and then 14,500. Are you guys following? Do you think this is difficult to go and just get 100 tomorrow? So that is how you record transaction that happened on the 26th. And then let's go to the next transaction. The next transaction happened on the 28th. We've got two transactions, transaction number on 28. On the 28th, we've paid wages. We also made an EFT payment to our suppliers in full settlement of our account of 6,500, right? So I'm going to start with the one of wages. So when you pay, bank is affected, is decreasing because you are making a payment from your bank. And then what did you pay? You paid for wages. So wages is another account. Wages is another account. So I'm just going to create an account for wages right there. Account for wages. right? Wage is right there. I see on the comments someone says, what a confident booster. You must go and pass. You don't want problems. Now, personally, I just hate failures. So that is why when I teach, I have to make sure that you guys go and make it. And then wages, remember we paid, right? So we are going to start from the bank. It decreases your bank, right? So you go to the bank account. When the bank decreases, we must always credit, remember. So why is the bank decreasing? We paid wages, right? How much did we pay? Let's just double check in the question right there. We paid 1,700 wage. So we go to our account, they say 1,700, I mean to say. And then we go to the wages account down there. Wages account down here. Remember, wage is an expense. This transaction took place on the 28th of Jan. And then we paid bank usuality principle of, and then amount 1,700. 1,700. Right. And then we go, there's another transaction that happened on the 28th, ne? Another transaction that happened on the 28th. So it means we have to add another account here. We have to add another account. We were making a payment, right, to our creditors. So creditors, I think creditors are there up there, ne? And then the bank is there. So let's see what is happening right here. Let's just go back to that transaction again and just read and get to understand what is really happening. So they say you made an EFT to pay JT suppliers in full settlement of our account. So now we received a discount. Why am I saying we received a discount? Remember, again, these people gave us a discount here of 5% and we recorded it. We minused it. Now we received another discount because if you check our creditors account up there, so this account is going to be what? Discount received, because we received a discount here. Discount received. We only, remember, we only account for discount received only when there's a settlement discount that we are given. When we settle our account and we're giving a settlement discount, therefore we will account for discount received. But if it's a trade discount, we just minus that 5%, we leave it like that. But when there's a settlement discount, is in this way. If you check, they said we paid 6,500, but how much were we owing these people up there? We were owing them 6,840, right? Which is this one. We were owing them 6,840, but we paid how much? We paid 6,500. So we go to the creditors control, because creditors control is affected, and then our bank is affected as well, right? Our bank is affected because we paid our creditors. So let's just go start from the bank, because there is 3 accounts affected. It's bank, is creditors, is discount received. So when we record, we come to the bank and say we received how much, we paid how much to our creditors. We're gonna say creditors, and then creditors, and then we go there, we paid how much? 6,500. That's what we exactly paid, 6,500. Then we go to our creditors. When we go to our creditors, we go to our creditors, We go to our creditors account. Our creditors account, we go to it decreases on the debit side because we're making a payment. So we're gonna say bank. It's decreasing bank. How much? 6,500 that we paid, right? And then we also indicate that we also received a discount. So it's gonna be discount received as well. Discount received. So discount received is going to be the difference between 6,500 and 6,840. I think you're gonna have 340 discounts. 340, right? 340. And then you go to your discount received account. Because it's an income account, you go to the credit side. These transactions happened 28 Jan. And then you're gonna say creditors. $3,000, 340. I mean to say not 3,000, but 340. Then you are done with transaction that happened on the 28th. Right?
Mr.
You're done. Yes.
For the 28, is it 3 accounts that are affected?
Yes. On the wages, on this one, remember, on this one again is 2, which is bank and wages. Are you following?
Yes, Mr.
And then on the second transaction, the 28th, we have 3 accounts. We paid. When we pay from our bank account. There's a decrease in our bank. Do you agree? When we pay.
Yes, Mr.
And then we paid who? We paid our suppliers, which is our creditors. Do you agree? So creditors is affected.
Oh, yes, I see, Mr.
And then instead of us paying 6,840, we paid 6,500. It means we have received a discount on our payment. Do you agree?
Yes, Mr.
That is why we've got 3 accounts affected, which is bank, because we paid. Who were we paying? Our creditors. And then we paid less than what we're supposed to pay. It means we received a discount, which is called discount received. 3 accounts. Yes, that's correct. 3 accounts affected.
The discount received rather comes from AID 19 Henker.
Yes.
Yeah, 5%.
Because,
okay.
Yes. Because again, they gave us a discount of 5%, we minused that one. Do you remember?
Yes, Mr.
And then we were left with how much to pay? 6,840, right? So now when we pay, they said we pay in full settlement. Why are we paying in full settlement to 6,500? It means they give us a discount because we're supposed to pay 6,804. That is our full settlement. But we paid 6,500. So the difference, it means we have received a discount for it, which is called a settlement discount. And then it's us receiving that discount because it's us who are settling. Are you with me?
Yes, Mr.
All right. Any question? As we proceed, we're just left with two transactions, and then I'll be done for tonight because I've got another session with another group, but that one is financial accounting. So you're not actually doing the same thing.
Mr.
Yes.
Regarding trial balance.
Trial balance, we won't do it, but I will just demonstrate and leave because trial balance is easy. Just debit credit. You just have to understand that in the balance sheet section, you record assets, ownership, and liabilities.
Mr. I wanted you to do question 3 from the question paper because I'm having a problem with it, but it's okay.
Unfortunately, I was supposed to start with others at 10:30, but I said they must wait. So that's why I said, do we do transactional? That's why when I asked to say, are we doing question 3 or are we doing question 2? So that I just try to balance that. But I'll try to send you something for you. Don't worry, in the group. Okay. So don't worry about that. I think it can be covered. We can just see what to do. And then let's go to the next transaction right there. Transaction number, the one that happened on the 30th, they say you bought equipment on account. Remember, when you buy something on account, it means you are buying on credit. You remember? So two accounts affected is going to be creditors and equipment. You bought equipment. So it's going to be creditors and equipment, right? So I'm gonna go to the answer sheet and create another account called equipment because already creditors we have up there. So equipment. So equipment is an asset. Equipment is an asset. We bought it on credit on the 30. On the 30. And then we bought it on credit, so we're gonna say creditors. And then how much did we buy it for? Let's see. We bought it for 19,000. So you're gonna say 19,000. Right? And then we go to creditors. There's an increase in creditors due to that we bought equipment on credit. So we're gonna go to creditors and increase our creditors with equipment right there. Equipment of 19,000. Okay, that's all. That's
There's an
transaction.
opening balance for equipment of
Oh, there's
60,000.
an opening balance for equipment.
Yes.
Okay, let's just do the right thing right there. Thank you for that. Let me do this. So this one is gonna be 1 chain. And then 2024 can indicate that. And then it's gonna be balance because remember equipment is an asset. Asset increase on the debit side. So their balance will be on the debit side. Balance are brought down. Balance brought down. And then how much is the amount for the opening? Let's see. The amount for the opening for equipment is 60,000. So you go to the answer sheet, we indicate balance brought down 60,000. Right, thank you very much for that. And then we can move to the next transaction, which is the last. The last transaction, they say bought a new vehicle on credit for 250,000, right? You bought a vehicle for 250,000. So it means we have to create another account called vehicle. We have to create another account, vehicle account, right? So vehicle account. Vehicle, remember, is a what? It's an asset, right? So vehicle. Vehicle, okay. And then vehicle, they say you bought it. Can someone mute quickly? Okay, thank you. And then vehicle. So there's an increase in vehicle, right? Because the transaction says what exactly? Let's just go to the transaction so that we can record the right things. So on vehicle, we've got opening balance as well, ne? So it means
Yes.
1 Jan. Let me just go and check how much is it. Opening balance on vehicle is 20,000. To answer the details, it's an asset debit balance brought down. Okay, of how much? Balance brought down of 20,000. And then they also said we bought a vehicle, right? We bought on credit, ne? And paid a deposit. That's what they said, ne? Let's see down there. They said we bought we bought a new delivery vehicle on credit. So we bought on credit, number one. That's what we're recording. We bought on credit. So when we bought on credit, just go to the on the 31st there. We bought a vehicle on credit, so creditors. Creditors, 250,000. There's an increase in vehicle. Due to that, we bought that vehicle on credit, so creditors. All right. And then we are done with recording this transaction into a vehicle, right? We go back to the bank because they said we bought, we also paid a deposit for that vehicle, right? So let's go to our vehicle account right there. I mean our bank account. We must go to our bank account and say creditors. Let's go to our bank account and say creditors. There's a decrease that we made a payment for our creditors. So when I come here and say creditors, uh, 25,000 of that deposit that we made for that vehicle, right? And then we'll also go to our, we must also go to our creditors and decrease them with 25,000. $25,000. Here and say bank. 25,000 of that deposit. Right? Because remember, every credit must have a debit. So we've debited bank on the credit side of the creditors, I mean on the debit side of creditors control, and we are going back up there on the bank account. We've decreased our bank with 25,000 creditors. Why? Double entry system or duality principle. Every credit must have a debit, and we've done that. Are you guys following right there? And then that's all for transaction for question 2. Remember, what I did not highlight, I'm just gonna take you through this exam preparation thing, right? Or test preparation. Next, remember this question will be on YouTube as well, if you want to visit it. And then let me go back to the question, right? To this question, remember, read everything. You see, all accounts that are up, they will not close them or balance them. Why? Because they said do not balance the accounts. So read the transaction thoroughly. Do not go to the exam panicking, because you are going to write panic there, to be honest. So just go relaxed, tell yourself that you are prepared and you are going to make it. Okay, so please read all the questions thoroughly, apply. Remember, your question 1 until the last question is going to be debit credit, because remember, accounting equation or the question we started with, there's debit credit, right? And then ledger accounts, debit credit. That means elements are everywhere. And then trial balance, debit credit, elements are everywhere. Are you with me? So just bear in mind that there is no way you're going to debit credit without applying the elements. So please go and redo these questions, and I know that you guys gonna make it. So please don't panic, be strong, because panicking after panicking, you won't then nothing will happen. You just panic, but you're still going to write. So don't panic. Just go there with confidence and tell yourself that you've studied, you've been taught, and you are going to make it. Have a lovely night and salute. Bye-bye.
Bye.